Hello everyone, welcome to Mr. Wong's Financial Classroom. Today I'm going to share with you some facts about estate planning and capital gain tax. When you do estate planning, there's something you cannot avoid, that is capital gain tax. So let's review some facts about estate planning first. Uh, when you do estate planning, we will have some uncontrollable factors and some controllable factors. So what are uncontrollable factors? Number one is deemed disposition rule. So what is deemed disposition? When a person dies, the Canada Revenue Agency, we simply call it CRA, considers that the person has disposed of all capital property right before death. I read it again. The CRA considers that the person has disposed of all capital property right before death. The CRA calls this deemed disposition. Then the person who received the gift, the asset, will be considered that he has received the deemed proceeds of disposition. Okay, so at the fair market value. Another facts that would trigger deemed disposition is when you leave Canada permanently. If you cease to be a resident of Canada in a year, you were deemed to have disposed of certain types of property at their fair market value. And when you left Canada, and you to have immediately reacquired them for the same amount, this is called deemed disposition. So if you're planning to leave Canada, I suggest you should talk to your tax accountant and ask for some advices. Okay, beware of that. Okay, let's go back to the uncontrollable factors. Number two is growth in property value. We buy property because we want the property to grow in value, right? And number three is capital gains inclusion rate. This is the rate that is set by the government. So nothing you and me can do it. Okay, this is to determine how much tax you have to pay. And the last one is marginal tax rate. That is the tax rate that you have to pay on the very last dollar that you earn in that year. All right, but the only thing we can control is to arrange money to pay for the taxes. If you know that you're going to distribute your asset, then you know the one who receive your property, your asset, your gift will incur some capital gain tax, then you might want to do something, plan ahead, right? I'm gonna show you the capital gains inclusion rate to it's like a refresher to remind you in the history, like according to this chart here, between 1972 to 1987, the inclusion rate was 50%, and 1987 to 89, that's 66 and 2/3%. 89 to February 2000 is 75%. February 2000 to October 2000 it went back to 66 and 2/3%. And from October 2000 until now is still 50%. So capital gain the taxable capital gain will be added to your income and taxed at the marginal tax rate. So you have to be very careful. For example, in the year of death, this person, if it trigger like 100,000 capital gain tax, and then also in the same year, his other income, his salary income is also 100,000. That means he might have to pay taxes on 200,000 income in that year. So this is something you have to be very careful, and you have to plan ahead. I am going now to give you a case study, deemed disposition at death. Just an example, okay? Okay, let's assume that these are the properties and the shares that you own. First of all, you own real estate. The purchase price was 500,000, but in the year of death, the fair market value is 1.5 million. So capital gain is $1 million. The real estate here is something. It's not your principal residence, not the home that you're living at right now, because you see primary resident right below the shares of company owned, right? So this real estate means something you generate revenue for yourself. We call it revenue property or rental property. So it will incur capital gain. Number two is you own some shares. The purchase price is 100,000. Wow. Now the fair market value is 1 million over I don't know how many years. This is an example, okay? So from here you have incurred like 900,000 capital gain. Number three is the primary resident, the home that you live at. Okay, your primary home. The purchase price was 250, but the fair market value is 750. But exempt, that means we don't pay capital gain tax on our own primary home, primary residence, right? So only one item is exempt right here. So in this example, the total capital gain we incur in the year of death is 1.9 million. And since now the inclusion rate is 50%, so 50% of 1.9 million is 950,000, right? So tax payable is 450,000, right? Let's assume the marginal tax rate is 50%. All right, you pay half of what you earn. Okay, 450,000 tax. This is the tax you have to pay to government in the year of death. Before, or your family can actually receive your gift, your asset, your property. Okay, what are you gonna do with this 450,000? How are you gonna prepare for it? Okay, let's look at the next slide. If you already know that you need to pay $450,000 tax, what I can think of is only 4 ways to prepare, to arrange to pay for the tax. Number one, if your family, they have no cash to pay for $450,000, they may have to sell the property that you give it to them, right? So, but if you want to sell your property in a short period of time, in a hurry, you might lose some money. You might not get the real fair market value. Plus, you have to pay a sales commission to a real estate broker. You have to pay for some legal fees, that kind of thing. So let's assume the cost is 30%. So every dollar will cost $1.30. Okay, so 30% more. So the total cost is $585,000. Okay, instead of $450,000. Number two, your family might want to borrow from the bank to pay for the tax. If they don't pay for this tax, they're not going to get it, right? The government will not allow the title to be transferred over to your family members. So you borrow from the bank, depends how much interest the bank charge you, and how long can your family pay off the loan. So let's assume the total cost is only 10%, right? So that's $495,000, okay, instead of $450,000. Okay, now you say, okay, I'm still working. Let me start saving money for them to pay the capital gain tax. Okay, in order to save $450,000, you have to earn how much? Approximately $750,000. Why? Because we all know that we have to pay income tax, right? So every dollar, in order to save every $1, you have to earn $1.67, $1.67 in order to save $1. And I assume your marginal tax rate is 40%, okay, tax rate. So, wow, it's so far doesn't sound good at all, right? It's not that easy. You might want to consider the last method here, last way, the smart way. I call it the smart way. Every dollar costs only 15 cents and it's guaranteed. Okay, so you may ask me what it is. Every dollar only costs 15 cents? Okay, let me show it to you. This way is to take out a permanent insurance policy. A permanent insurance, that means this insurance policy will never end unless you cancel it, right? It's never end. We are using the insurance money to pay for capital gain tax. In this example, I'm assuming that you are male, age 40, non-smoker, okay? And the insurance amount is $450,000 because that's the capital tax amount that you anticipate your family has to pay. And in this example, this policy is a 20-pay policy. So I put guaranteed 20-pay here. The annual premium is $8,184.95. That means if you pay $8,184.95 each year for 20 years, this policy is paid up. No more premium is required, okay? You own the policy forever. So the insurance amount will grow slowly year after year after year. So in this example, when you are 85 years old, the insurance amount will have grown to $1,077,596, right? Instead of only $450,000 to start with. If you live till 100 years old, or you said, oh, how many people can live till 100 years old? You never know. Now people seems to live longer and longer. The policy, the insurance amount in this policy will be about $1.6 million, right? All right. So how much premium, how much have you been invested into this policy? You pay premium for 20 years. The total amount you have paid from your pocket is $163,699. That's it. No more premiums required, right? So based on the premium you have paid, that's 36% of the initial insurance amount. The initial insurance amount is $450,000, right? So that's 36% only. That means every dollar you give to your family, it costs you 36 cents. And I would remind you again, this insurance money is tax-free. They don't pay tax, all right? And at age 85, if you pass away at age 85, they were going to get more than $1 million insurance, right? So, but you have only paid $163,699. That means it costs you 15 cents of, every dollar of insurance money that you give it to your family. So that's 15 cents, 15%. So this is a guaranteed way, a quickest way, because we all know that when you take out an insurance policy, when you're being approved, you have paid the initial premium. Even if you pass away in the second year and the third year, insurance companies still have to honor the policy. They still have to pay at least $450,000 tax-free money to your family. Right? This is guaranteed money. So you might want to consider that. So sometimes insurance policy can help a lot. You can consult your tax accountant. They might not be aware of it, but it works, believe me. All right. So thank you so much for watching. I hope you like my video. If you like it, please subscribe to my YouTube channel, and I would have more video coming up. Thank you, and have a good day.